Let's talk about the relationship between the cash growth and the death benefit in permanent life policies. Let's start with whole life. So let's say we have here the death benefit DB, which is something like this when we start the policy. As we pay premiums and earn interest, we also build a cash value. At some point, the cash value is going to grow. Then the death benefit is also going to grow. Then cash value will grow again. Guess what will happen? Death benefit will grow one more time. So you will always have a situation where the death benefit is bigger than the cash value. But after some time, the cash value will grow to be the same value as the death benefit. And when this happens, we say that the policy has matured. In general, this happens at age 100. If you paid attention to this series, one of the key things with whole life is the premiums that you pay are leveled. Also, early on in this series of videos, I mentioned that the cost of insurance increase with age. So how is it possible then that whole life will keep the same exact premium for the entirety of your life while the cost of insurance is increasing? Well, it comes down to how this policy is structured. Some people will say that, hey, if you use whole life, you will either get the cash value or the death benefit. This is true. So if you pass away here, your beneficiaries will get this one. They will not get the cash value. But this doesn't mean that the insurance company is taking your cash away. I will even argue that you want things to be this way if you use whole life, because this is the only way you can ensure that you will have the death benefit. So let me explain it to you. So let's draw another chart here. On this side, let's put the cash value. And here, the death benefit. Let's just call it DB. Your cash value is going to grow using compound interest this way. And if I put the death benefit here, because it's going to be a specific death benefit, this is how things work. Early on in your policy, what happens is that you pay to get this entire death benefit. So the cost of insurance is on this entire death benefit. And as the cash grows, look at what is happening. You start paying for less and less death benefit until you get to some point where both are equal. So what happens here is that your cash value is used to offset the cost of purchasing that death benefit. It's like you're building your own death benefit over time using your cash value. And that's why this death benefit is the only thing that you actually get when you pass away. There's no cash value to get when you use whole life, because the cash value is basically used to build the death benefit so that sometime in the future your policy will mature. But you can access the cash value when you're still alive. Okay, you can access it through a loan or through a withdrawal. So while you are alive, you can access the cash value, but ultimately, when you pass away, you only get the death benefit. Now, let's talk about Index Universal Life. First of all, we have the increasing death benefit, and then we have the level death benefit. Those are the two death benefit options that we will explore. So when we start the policy, let's say that death benefit is this guy. And then as we pay premiums and earn interest, we build a cash value. Look at what happens here. So when we build this cash value here, the death benefit becomes the initial death benefit plus the cash value. Then it grows more. This guy grows more. Then it grows again. I think you get the point. So now, if you pass away, your beneficiaries get this one. Some people say, hey, we like this one. Why? Because to their point, whatever they earn as cash value can now go to their beneficiaries plus the initial death benefit. In theory, that's good, but you have to understand the consequences of doing this. So remember what I said earlier, the cost of insurance increase over time. So what does that mean? So as you age, here you have the cost of insurance is going to increase. Now, if you look at this chart here, the initial death benefit has not changed, meaning that the net amount at risk, the amount of money that the insurance company has to come up with when you pass away, has not changed. So let's assume that it's $500,000. Okay. Since you still have that $500,000 that the insurance company has to come up with if you pass away, you are paying a cost of insurance on $500,000. Remember this chart? Let's say that you get this policy when you're in your 30s. Maybe the cost of insurance is going to be something like, I'm just giving random numbers here, $50 a year. Maybe by the time you get to 60, this cost of insurance is going to become $1,000. So my point here is that this is very dangerous. If you don't pay attention, you could get to a point where fees grow so much to the point of eating the cash value that you have built. And it could even get as bad as you get a call from the insurance company saying that the policy is about to lapse if you don't bring more premiums. Let's take a look at the difference with the level death benefit. So one more time, let's draw again. Here, let's say that you start with this death benefit. As you pay premiums and earn interest, you build the cash value. Once you build this cash value, you know what happens? The cash value comes down here. Once more. So what you can already say is that as your cash value increases, you are basically purchasing less insurance. Let's say it goes like this. Then you get to something like this. So now you're just paying insurance for this small portion. Now, something interesting happens here. At some point, the cash value will grow to be equal to the initial death benefit. And when that happens, the life insurance company is going to increase a little bit the death benefit. Why? Because per law, there has to be a distance between the cash value and the death benefit. Now, what is the benefit of doing this type of design or using this type of death benefit option? The death benefit that we are purchasing or the cost of insurance that we are paying for keeps decreasing as the cash value increases. And as a result, we pay lower fees in cost of insurance because we are purchasing a lower death benefit. So for instance, maybe we started with a death benefit of $500,000. And by the time we get here, we're actually paying maybe for $50,000 of cost of insurance. So even though we may get older, we end up paying less fees over time in cost of insurance, which will also decrease the chance of the policy lapsing and will give us a better chance of success. It's important to remember that if you plan to take money out of your policy, you should keep an eye on the cash value, the fees, the death benefit, and the death benefit option. So with whole life, it's much more a set and forget. But whenever you decide to use an index universal life, you have to keep monitoring the policy and make adjustment as the time goes on. With this, I'll see you in the next episode.